Hey, happy Monday morning, everybody. Wanted to give you a quick update on a few topics that have been in the news or obviously are pertinent here recently. So touch a little on debt ceiling, I bonds, and overall interest rates. So debt ceiling first. What is it? I think most of us probably know, but real quick, it's a limit placed on the total amount of borrowing that the government can do. And since January, we've basically been operating at that maximum limit. And so Congress has to approve additional borrowing. So uh, supposedly we're going to run out around June 1st. And so that's kind of where we're coming to that deadline. This isn't the first time it's happened. We actually went over that deadline back in the Obama years. And so this crisis, if you will, it's not anything new, but being that we have, a divided Congress, it's sort of an opportunity for political gamesmanship, which is obviously what we're seeing, which is what's we've all heard the news and been going on the last couple of weeks. And so what we fully expect is that a deal will be reached. Obviously, the Republicans don't want to extend the debt ceiling without some agreement on cuts in spending. Now, of course, cuts in spending for in reality, that what they're really pushing for is they basically want it to freeze, keep it at 2022, 2023, maybe the levels they come back to. And the Democrats don't want to discuss anything in terms of any cuts to spending until after the debt ceiling has been raised. So in a nutshell, that's the impasse we're at. Now, them failing to come to any kind of resolution or agreement, though, can have some pretty big and serious repercussions. In theory, if the U.S. really defaults or delayed paying, of their federal obligations, that could see stops in federal benefits, job losses, obviously higher in borrowing costs, not just for the government, but sort of trickling through the entire economy. If the U.S. gets downgraded like it was in 2011, obviously that has longer term, repercussions as well. So the bottom line is Congress has always, after a lot of hand wringing, and blaming of each other, they've always sort of come ultimately to the point where they can get an agreement, raise the debt ceiling. And so while we anticipate, the closer we get to June 1st, we probably are going to have some volatility, assuming that they do ultimately get that agreement and the debt ceiling raised. We think that volatility or negative pressure we may see over the next, week to 10 days is likely short-lived. So the other I wanted to touch on, I bonds, we've touched on before. Those rates continue to come down. As the official numbers from the government say inflation is gradually coming down, I bonds are now paying 4.3. So a far cry from this time last year when they first jumped, up above 9.5%. So for most of you that have I bonds, we can say we've entered that point where they're probably not worthwhile to continue much longer. If you recall, there were some pretty big restrictions around I bonds. Only 10,000 per person per year. Also only non-retirement or non-qualified money. And you had to hold it at least 1 year to be able to cash it in at all, but actually 5 years to have no penalty. So as a reminder, that penalty is 3 months worth of interest. So here's the strategy that we're talking about with most of you. If you do own I bonds, prior to it dropping to 4.3%, which it did in the beginning of May, it was still paying upwards of 6.5%. So rather than cash it in now, because you'll be giving back, some of those 3 months that were still at 6.5%, general strategy would be once your I bonds are paying the 4.3%, you probably keep it for 3 more months and then ultimately cash it in. Or at least that's what Rachel and I are doing. So we bought ours in May, probably around August, September, we'll go ahead and cash those in. And the reason being, as we talk about general interest rates, the Fed raised rates, of course, in May. They signaled that they're likely close to a pause or close to being done with this interest rate increasing cycle, although they'll continue to let the data, guide them. Comparatively, when we look at I bonds, we can say if they're paying 4.3, money markets within Fidelity are now paying almost 4.75. 1-year CDs are around 5.1. Fixed accounts, fixed annuities are about 5.5 to 5.6. But what we are seeing is even the markets are beginning to price in that rates will probably be lower a year from now. For example, that 1-year CD is 5.1. 2-year CDs, though, are about 4.95 to 5%. So the 2-year rate being lower than the 1-year rate is definitely call it a abnormality. So that also has us thinking, for those of you who are normally purchasing CDs or purchasing regular fixed annuities, as those mature here in the short run, if you have anything that's maturing now or the next 6 to 9 months, you may be considering going out farther than 12 months. Is this the time to begin locking in those rates for 2 or 3 years? Because more than likely, 12 months from now, rates will be beginning to decline. So a few things I wanted to share with you of just where interest rates are today, a little bit more about, the debt ceiling and what's going on here with the economy and the markets, and of course, that update on the I-bonds. Should you have any questions, as always, feel free to give us a call, shoot us an email. Have a great rest of the day. Thanks.